My dear students, in the third week, we are going to discuss about the dividend tax, and in this particular module, we will discuss the taxability of the dividend. But going into detail about the dividend tax or dividend distribution tax, we should know the dividend. What is dividend? Simply, we can say the dividend is a slice of profit. Actually, it is returned to the shareholders. Now, the dividend is the amount paid to or received by a shareholder proportionate to his or her shareholding in a company out of the total amount distributed. So, the amount which is being earned by the company after distribution to its lenders or creditors, the remaining part is to be distributed by the company to its shareholder according to their shareholding. So, this part of distributed profit is known as the dividend. Dividend can be of two types, that is interim dividend and final dividend. What is interim dividend? As a student of commerce, you know the interim dividend, the dividend which is distributed or paid before the end of the financial year. That is, before closing the financial statement or before closing the financial year, the company may declare the dividend. The board of directors is empowered to distribute or to declare such type of dividend. This is interim dividend. Basically, the interim dividend can be paid quarterly or monthly, depending on its profit, quantum of profit. So, this is interim dividend. And final dividend, the dividend which is paid after closing of financial year or at the end of the financial year, and it is distributed and paid after the financial year. So, this is the dividend, interim dividend and final dividend. Now, the dividend can be distributed or paid out of current profit or the accumulated profit. What is current profit? Every company is required to prepare the statement of profit and loss as per the Companies Act. So, the profit shown in the statement of profit and loss is the current profit. The company may distribute the dividend or pay the dividend out of its current profit. Current profit means the profit of the current financial year. And the company may also distribute the amount of dividend from accumulated profit. In Income Tax Act, Section 2, subsection 22 describes certain distribution as the dividend, which is known as the deemed dividend. So, as per Section 2 of subsection 22, the company may distribute certain items to the extent of accumulated profit, which may be termed as deemed profit. Let's see what are the items, what are the distribution which are termed as deemed dividend under Section 2 subsection 22. As per subsection 22A, there are 5 types of deemed dividend as per Section 2 subsection 22 of the Income Tax Act. Number 1 is the distribution of assets by the company to its shareholders. It is described in Section 2 subsection 22A. Number 2 is the distribution of bonus shares to preferred shareholders or debentures to any shareholders. This is Section 2 subsection 22B. The third one is the distribution on liquidation of the company. Liquidation of the company may distribute to the extent of accumulated profit, which is described in Section 222C. And number 4, distribution on reduction of share capital as per Section 2 subsection 22 clause D. And the last one is 222E, loans or advances to certain shareholders or concern. But the last one, that is Section 222E, is not covered under Section 115O, that is, it is not subject to dividend distribution tax. all the above distribution, that is the distribution of assets, the distribution of bonus shares, the distribution on liquidation of the company, and the distribution on reduction of share capital, that is section 222A to 222D, all the distribution will be treated as the deemed dividend. And if it is a deemed dividend, it will be taxable in the hands of the company. So, as per section 115O, the section 2 subsection 22 clause E is excluded. It is not taxable in the hands of the company. Now, I have told you that the distribution to the extent of accumulated profit will be treated as deemed dividend as per section 2 subsection 22 clause A to D. If the company distribute certain amount, or it may be asset, it may be bonus share, it may be certain items on liquidation, over and above the accumulated profit, that excess amount cannot be treated as deemed dividend. So, this is all about the deemed dividend. Now, I have explained the distribution to the extent of accumulated profit. Now, you have to know what is accumulated profit. Accumulated profit is included the credit balance of the profit and loss statement, the general reserve, the investment allowance, the capital profits and profits of the year after the date of distribution and liquidation. It is very clear. The definition is very clear of accumulated profit, because whenever you say the deemed dividend as per section 2 subsection 22, you have to mention the accumulated profit, because up to the extent of accumulated profit, the distribution under section 2 subsection 22A to 222D will be treated as deemed dividend. If it is over and above the accumulated profit, the excess amount cannot be treated as deemed dividend. So, you have to know the concept of accumulated profit. Here, accumulated profit includes the credit balance of the statement of profit and loss, the general reserve, the investment allowance and the capitalized profit, and the profits of the year, that is the profits of the current year up to the date of distribution. So, this is the accumulated profit. And certain items are excluded for the purpose of accumulated profit for the purpose of this section. That is, you have to remember that provision for income tax, provision for dividend, reserve for depreciation will not form the part of accumulated profit. So, these items to be excluded for the purpose of accumulated profit. Now, the taxability of dividend. How do you determine the taxable amount of dividend? So, as per the Income Tax Act, only the Indian company, only the domestic company is liable to pay tax under section 115O on dividend declared or dividend distributed or paid by it. So, if the dividend is declared, the company is liable to pay tax, that is the Indian company is liable to pay tax. If the dividend is distributed, the company is liable to pay tax under section 115O. If the dividend is paid by the domestic company or Indian company, the company is liable to pay the tax under section 115O. So, the giver company, mind it, the giver company is liable to pay the dividend tax, which is known as the dividend distribution tax. In short, we can call it DDT, dividend distribution tax. So, the recipient is exempted, that is the shareholders are exempted from paying the tax on such dividend who is receiving the dividend under section 10 subsection 34. So, only the company, only the Indian company or only the domestic company is liable to pay on dividend distributed or declared or paid. Okay, is it clear to you? So, dividend declared or distributed or paid by a domestic company is liable to pay tax as per section 115O. So, who are taxable? But or when it will be taxable? Dividend from foreign company and deemed dividend under section 222E is taxable in the hands of the recipient. So, these are exempted, or these are to be taxed in the hands of the recipient. Recipient is shareholders. Dividend from the foreign company and dividend under section 222E is taxable in the hands of the recipient. Now, when the DDT is payable, it is clear to you that domestic company who pays the dividend is liable to pay tax under section 115O. Now, when it will be paid? There are 3 dates you have to keep in mind: the declaration of dividend, the distribution of dividend, and the payment of dividend. So, the 3 dates may differ from each other: the declaration of dividend, or distribution of dividend, or payment of dividend. So, the company should pay the dividend distribution tax within 14 days of dividend declared, or dividend distribution, or dividend paid, whichever is earlier. So, you have to check the date when the dividend is declared, when the dividend is distributed, and when the dividend is actually paid. So, there are 3 dates. The company has to pay the DDT, that is dividend distribution tax, within 14 days of these 3 dates, whichever is earlier. So, the dates are very important. Now, what will be the rate of tax? As a student of commerce, you should know the company pays the tax as per Income Tax Act against its income. This is a normal income tax. The company who pays the dividend tax, who pays the dividend, or who distributes the dividend from its profit, is also liable to pay the dividend distribution tax in addition to its normal income tax. So, the company is bound to pay the tax on its normal income as well as the tax on dividend distributed by it to its shareholders. So, the company pays 2 types of tax: the normal income tax and the dividend distribution tax if it pays the dividend to its shareholders for a particular financial year. And now, the question is, what would be the charge? What would be the rate of DDT, dividend distribution tax? As per Income Tax Act, the company, the domestic company who pays dividend is liable to pay tax at the rate of 15%. You have to add the surcharge at the rate of 12% and the SHEC, that is secondary and higher education cess, at the rate of 3%. But here 15% is to be calculated on the gross dividend, mind it. So, how do you calculate the gross dividend? Suppose the company pays dividend ₹100. Now, the DDT, that is dividend distribution tax rate, is 15%. So, you have to gross up this dividend. How do you gross up? The gross up would be derived as the dividend 100 by 85. That is, you have to gross up 100 by 85 into the dividend paid. At the time of case study, it will be clear to you further. So, in this current lecture, we have come to know the dividend, dividend distribution tax, and the different types of deemed dividend as defined in section 222 of the Income Tax Act. I hope this lecture will be clear to you again when we will take the case studies in the next lecture. Thank you.